If you're a construction contractor doing real revenue, there's tax strategies out there that you've definitely never heard about. And these aren't loopholes or gimmicks. They're real structures that work when done right. Today I'm breaking down one of those strategies, a management C corporation, how it actually works for contractors and how to set it up correctly so that you don't get in trouble with the IRS. So let's get started. So if you're new to the channel, welcome. My name is George. We talk all things accounting for contractors here. So before we dive into this one advanced tax strategy, we need to make a conceptual distinction between how you run your business and the various functions in it. On one hand, you have the operating company, and this is the part that everyone understands. It builds projects, employs field labor, owns or leases equipment, purchases materials, signs construction contracts, and bears construction and job site risk. This is the boots on the ground business. On the other hand, you have to think of it as there's a management and executive function component to your business. This is the part that quietly drives profitability, and it includes executive leadership, estimating systems and pricing strategy, financial oversight and controls, HR, payroll and compliance, safety programs and risk management, and strategic planning and growth decisions. Most contractors mash all these functions into one entity. But sophisticated contractors, the ones who've really scaled their business, at some point, if they're smart, they will make this distinction and separate them by entities, but that separation must be real. So what is the Management C-corp and what does it actually do? The Management C-corp is not a construction company. It does not employ crews, it doesn't touch materials, it doesn't run job sites, it doesn't touch contracts, and it definitely doesn't take construction risk. Instead, it provides management and consulting services to the operating company. These services can include executive and strategic leadership, business systems and oversight, estimating methodology and pricing frameworks, financial controls and reporting systems, compliance, HR and safety administration, and risk management and long-term planning. So think of it like the operating company are the hands of the entire operation and the management company are the brains of the entire operation. And that distinction is everything for tax purposes. So this is where a personal service corporation comes in. And to make it clear, we're not talking about a professional corporation, we're talking about a personal service corporation. And the IRS generally classifies these as C corporations for federal income tax purposes. So why does this matter and why would you do it? Why would you set up a personal service corporation? Because number one, these corporations are taxed at a flat 21% rate. They do not get graduated corporate buckets. So there's definitely a favorable rate treatment there. But the IRS uses two tests to determine personal service corporation status. Number one is the function test. At least 95% of the corporation's activities must be the performance of personal services. So for contractors, this typically means management consulting, executive oversight, strategic advisory services, and business systems and controls. So if your C-corp is advising, managing, consulting, and designing systems for the operating entity, and as long as it's not performing any construction, it may meet the function test. If it's running job sites or directing labor, it will fail the test immediately. That's number one, the function test. And number two, there's the ownership. With the ownership test, at least 95% of the stock must be owned by employees who perform the services, or former employees or estates. That means no outside investors, no passive owners, and no spouse ownership unless they are actually working in the business. So why do we talk about this today and why is this a structure that can actually work for contractors? Because when done correctly, this structure can actually be very powerful. It can centralize executive comp, support legitimate management fees, create cleaner financial separation, meaning a lot of asset protection that could go into this, improve scalability across multiple operating entities, support long-term exit or succession planning, and reduce operational chaos as revenues grow. So a clean example will look like this. The operating company is an LLC or an S-corp, employs all field labor, may own the equipment, executes construction contracts, and the management company, the C-corp, employs the owners or executives, provides documented management services, charges a reasonable and defensible management fee, keeps separate books and bank accounts, and operates like a real consulting business. This is not a tax loophole, it's more of an organizational design with tax benefits when done correctly. So what are the three main mistakes that can be made? Number one, fake management fees. If there's no management agreement, no description of services, no allocation or time tracking, or no consistency, the IRS will say this isn't a fee, this is disguised as wages or distributions. Number two, blurred operations. If the management company directs job sites, directs field labor, manages the construction itself, or signs construction contracts that will collapse the structure. So again, you want to make a distinction between the actual field work and the executive strategic management, the more brainier side of the operation. And number 3, blind trust and bad advice. So if your advisors can't clearly explain the personal service corp classification, function and ownership tests, reasonable compensation, and the pricing concepts, they're probably doing guesswork and it might not survive an audit. So here's the bottom line. Your construction company itself should never be a personal service corporation, but a separate management C corporation can exist and a lot of times should, provided that it actually provides a lot of these services that we had mentioned. Again, management and consulting is the big blanket term. You have to make sure that this entity is clearly separated from the construction itself. The compensation and fees are reasonable. Documentation is airtight and the structure reflects the economic reality. So this is not DIY territory, but when done right, it's one of the cleanest ways contractors could scale without losing control, and also getting some tax benefits and asset protection. So if you're a contractor thinking about a management company, multi-entity structures, and scaling past a single operating company, don't DIY this, don't do guesswork. Our calendar link is down in the show notes. Feel free to book a time. And I hope you found this helpful and see you in the next one.